Good morning and welcome to Financial Strategies with Scott Wardell. While various products may be discussed during the course of this program, please note that these discussions are intended only to educate you about financial topics. They are broad in scope and do not consider your individual personal financial situation. You should work with a qualified financial professional in collaboration with your attorney and tax advisor before implementing any financial decisions which will affect your personal financial situation. Thrivent financial representatives cannot provide legal or tax advice. Your local Thrivent representatives are Wayne Grunkley and Alan Sogstead, 215 Atlantic Avenue, Morris. Call 589-1731. And now, Financial Strategies with Scott Wardell.
And welcome, everyone, to another edition of Financial Strategies with Scott Wardell. Of course, another day and another week, and here we are, and we got ourselves a pretty nice... We've had a very nice week this week, haven't we, Scott?
It's been hot.
It's been hot,
but it's been a good week, and here we have found ourselves in the very last Saturday of July. And, I'm asking myself, what happened to this month? I mean, seriously, it just disappeared. And, I've got a funny feeling that there's a bunch of congressmen that are asking themselves the very, very same question. What happened?
What might you be referencing, sir?
Right.
I have no idea what you might be talking about.
Absolutely.
If only there was a story or two about this
Yep.
that would help us out. And all, it's also one of those rare years where we get 5 weekends in July, too.
That's right.
Because we had, the first and second was, and now here we are, 30th and 31st.
And we did get some summer, so we were complaining we weren't going to get summer, and it came, and now, now we would wish that it would cool off just a little bit.
Yeah, remember the late May when we were talking about when's summer coming? Yeah.
That we didn't think it was going to arrive, and it arrived big time.
We definitely got it, that's for sure.
Absolutely.
Of course, Scott Wardell with us, and we do have a very special guest with us today.
We do. We have Russ Swanson. He's the Chief Economic Officer from Thrivent Financial, and Russ, we're just delighted that you could be here today. Honored, actually.
I'm happy to be here, Scott.
And I appreciate all that you've done in your role as Chief Economic Advisor as well. You've done just an absolutely spectacular job. And before we really dive into the
Scott,
topic,
before we get to that, he was so nice for us today. He even got a haircut yesterday for being on the radio.
Isn't that awesome? Very few of our guests go to that effort, Russ. So we're very pleased about that. We're honored.
Anything for you guys.
So before we get into today's topic, and we've got a lot of really good meaty stuff for our listeners here today, because how timely is this to have Russ on when we've got this looming federal debt ceiling and all of this stuff going on, to help us understand and explain some of that to us, and give us some good translation. What do we need to be worried about along the way? But before that, Russ, tell us a little bit about yourself, and your background, if you would.
Thanks, Scott. I grew up in Minnesota, in the Twin Cities. I went to college at Gustavus Adolphus College in St. Peter, Minnesota. A lot of people will be familiar with that school. I did my graduate work at the University of Minnesota, where I got an MBA concentrating in finance in the early 80s. I've been in the investment management business for 30 years, and I've been the Chief Investment Officer at Thrivent since the beginning of 2004. So coming up on my 8th anniversary here in a few months.
Fantastic, and what a job you have done. All of us that are out in the field appreciate the work that you do, frankly, because it really helps us serve our clients so exceptionally well. So I really
thank
appreciate
you for that. I don't do it all myself.
Well,
I have a lot of good people who support me in my group, but I appreciate the compliment. Thank you.
And having said that, I think the number is about $73 billion that you guys oversee?
About $75 billion between the general account of the insurance company and the mutual funds and variable portfolios.
I was only off by $2 billion this morning, Adam.
So close.
So close.
It's like the national debt. You're so close.
I should be in Congress.
Right.
Really?
That's right.
That's fantastic. Well, Russ, let's first of all talk about the markets, and we're going to get into this whole debt ceiling thing here as we go on this morning. But give us an update of what the markets have done so far this year. Mm-hmm. We're 7.5 months into the year, or actually today we're 8 months. We got them behind us here, or on our 8th month. So if you can just help us figure out what's going on. Yeah, exactly.
Well, I'm happy to talk about that. Actually, there's so much. The news is dominated with such bad news that I'm glad we're actually starting with this because the picture for markets is actually maybe surprisingly good. For example, corporate earnings are actually at an all-time high. They're above the levels that they were in 2007 before the downturn. That probably surprises people.
Nobody's talking about that at all.
No, and it's surprising. I find that a little bit surprising. If you look at where equity indices like the Dow, a lot of people follow the Dow. That's up just shy of 5% for the year. Now it's chopped around a lot. There's been a lot of volatility, and probably for good reason. But that's up almost 5% for the year. I like to follow the S&P 500. It's a little broader index. That's up about 2.75% since the beginning of the year. But let me give you some earnings growth numbers. Earnings and sales for the S&P 500. In the first quarter, sales grew by 9%, and net income grew about 17.5%.
Okay.
Tremendous growth there.
So let me ask you on that one, because we hear all this stuff on the news that consumers aren't spending yet. So when you say sales are up, how do those two things come together? If consumers aren't spending their money and sales are up, where are the sales coming from?
Well, consumers are spending. I think we'd like to see it growing faster than you'd like. But one thing to remember about a lot of people don't realize about the S&P 500, and these are the 500 biggest stocks in the U.S.
Right.
Is that about 40% of the earnings come from overseas.
Sure.
The largest share of that from Europe and Asia, and those places, particularly Asia, has been very strong. So, a lot of folks are looking for international diversification. Frankly, you get a lot of that just by investing in big companies in the United States, where a lot of the earnings come from overseas. So they're being helped by that. I'd like to add, we're getting earnings announcements now for the second quarter.
Yep.
So let me just cover that. And about 60% of the companies in the S&P 500 have announced earnings. And the growth rates there for the second quarter are looking good as well. So far, sales up over 13%, net income up over 18%, almost 19%. I think when it's all said and done, those numbers will be a little bit less, but still quite good growth.
Yeah.
And I would add, of course, we need to be thinking forward rather than back. Our expectation for the second half is still for positive growth, a little more modest than that. Maybe 9% sales growth and growth in net income of about 12%. So, good, solid corporate performance, which, as I say, I'm glad we're starting with this because so much of the news that we see is disappointing, and people need to understand that there is actually some good news out there.
Well, and one of the things, Russ, that people hear all the time on the little snippets on the 5 o'clock news is the fragility of this recovery. So when I hear your numbers, at least it makes me feel like there's some pretty substantial stuff, happening in the economy in real growth. So should what they just heard make them feel more confident that we're, no double dip, not as fragile, or what are your thoughts?
Well, I think you're right to wonder about the future because the markets are always thinking about not what's happening today because that's something that's already known. It's usually in the price of securities, but what's going to happen next? I will say that GDP numbers came out yesterday. They were disappointing. Domestic GDP, that's the growth in the economy.
Right.
They were a little bit disappointing, and the first quarter numbers were revised down. So the first growth in the first half this year was shy of 1%. That's not very good.
Right.
We're expecting for the year somewhere around 2% growth. So a good question is, well, is 2% good? Sort of how do you think about what a good number is and what a bad number is? And, when the economy is humming along, and employment is good, 3% is kind of what you expect to get. But coming out of a deep recession like the one we had, you actually expect more than 3%.
Sure, makes sense.
And in fact, you need more than 3% in order to drive unemployment down. So you can have growth like we've seen below 3, but what happens is the employment statistics tend to actually get worse rather than better, exactly what we've seen.
Yep.
And so it doesn't feel very good even though it's positive.
Okay.
So our expectation is for continued growth, but not really the numbers that we'd like to see coming out of a deep recession. You know, when the economy has gotten back close to the levels that it was at before the downturn.
Right.
But 3 years have passed.
Yes.
So that means that we're missing about 3 years worth of growth,
Sure.
which means that we're about 6% below the potential for the economy. So if you take that and you say, well, if we close that gap over the next 4 years, that means we should grow at 3% plus another 1.5%, or we ought to be, expecting 4.5% growth
Yeah.
over like the next 4 years. That would be a good situation, and that would mean a good things for tax revenues and the budget, employment, as well as corporate earnings. So that's what we'd like to see. We haven't been seeing it yet.
Okay, so as our listeners are thinking, well, what does this all mean to them? Without a really robust economy and recovery, then their neighbor who doesn't have a job is probably going to be waiting a little bit longer to to get that job. I mean, pounding the pavement is really the rule. People who I work with where one spouse or the other is unemployed, they are really working it hard.
Yep.
And I think that's going to be the key going forward, is that you're going to have to just work it that much harder, to make it happen. Having said that, at some point in time, this economy's got to get fired up a little bit, doesn't it? I mean, we cannot sustain this slow growth. I mean, we're going to call it slow growth. It's super slow when you describe, it's about 1/3 growth from a growth perspective, being 1% versus 3%. Where we need to be.
Yeah, I'd agree. I've been calling it a half-speed recovery.
Yeah.
A lot of people, they look at it a little bit black and white. Are we going to have a double-dip recession, or are we going to have a robust recovery? What we're really seeing and what we expect to see for the next 18 months or so is what I've called a half-speed recovery. We'll be making advancement, but it's not going to feel very good because it's not enough to improve the employment picture very well, and it's going to feel like a recession, even though technically it's not really a recession. So It's important, I think, to understand you can have positive growth and make some progress, but not, and have it not seem very satisfying, if you will.
Right. So it's really not the pure definition of a recession, as you
That's
say,
right.
but if you were to measure recession potentially a little bit differently, it does feel a little bit like that.
If you look at public opinion polls, about 75% of people still think we're in a recession, even though we've been experiencing growth. And I think that when they respond to that question, what they're really responding to is the employment situation.
Absolutely. And we've learned a couple of big lessons from the recession, and I think it's translated into some real behavior on people's behalf, because one of the reasons they're not spending is they're paying down debt. That's a real recession reaction, is to say, I can't, I got to get out of this debt. It was a wake-up call for many people, and I think that, that's probably, if there's a good side of it, people who have overextended themselves are really paying a lot more attention to that. And I think the data backs me up on that.
Yeah, absolutely. Savings rate has risen from about 0 to about 5% in the economy. That's a big change, and frankly, we need to go through that in order to get on firmer footing.
Absolutely. We've got Russ Swanson today, Chief Investment Officer for Thrivent Financial. And when we come back from our break here, we're going to really dive right into this, the debt ceiling and what is the effect of this debt ceiling. So stick with us here, because we've got some really good stuff coming up in just a minute.
A lot of great stuff. We'll get you a lot of answers on what all this talk is that's going on up at the Capitol, the U.S. Capitol, and we'll get you more answers, more financial strategies with Scott Wardell. Our guest this week is Russ Swanson, and don't forget, still to come later on, we'll have our deal of the day. That'll be coming up later. You got to keep listening, though. It's Financial Strategies. Have yourselves a good one. We'll be right back right after this.
How would your financial life improve if you changed just one thing? Avoid ATM fees, make your gifts rather than buy them, protect yourself from identity theft, save more for your family's future. The list goes on. If you heard something today on financial strategies that motivates you to change one thing in your life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing. Think about your finances, your lifestyle, your wants versus your needs. What one thing can you change today and see the impact tomorrow? Perhaps your family will save all your change for a month and donate it to charity. Maybe you'll finally write a will. Whether you choose to start simple or take a big step, that one thing can really make a difference. If you heard something today on financial strategies that motivates you to change one thing in your financial life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing.
Hey, we're back here with Financial Strategies with Scott Wardell. Our guest this week is Russ Swanson. Yeah, he controls a little bit of the money there, I guess, is the best way to put it, as he joins us here.
Absolutely.
On this Saturday. And we talked a lot about where we're at, really, as a country, how things been going so far this year. As we're finishing up the 7th month.
Right, and I hope that people grasp the fact that there is some good news among all of this. You know, that corporate earnings are looking really quite strong at this point in time, and the reports have been coming in good. But of course, we know what's on everybody's mind, and I know most of our listeners are kind of struggling with, gosh, I hear all this stuff about the debt ceilings and, you know, the national debt, the deficit. You know, what does all of this really mean for us? So Russ Swanson is here with us. He's the Chief Investment Officer for Thrivent Financial. And Russ, walk us through a little bit about the whole debate and why this is important, what effect it might have on us.
Sure. Well, let me start first by just saying a few things, and then we can dig a little bit deeper.
Sure.
The first thing I will say is that I believe strongly that sooner or later there will be an agreement on raising the debt ceiling. It has to happen, but we have to go through the political drama before we get there.
They're actually handicapping that on the news this morning, so they want to be part of the handicap. What are the odds?
Handicap? Is there going to be odds in Vegas, please?
Right, exactly. So they're handicapping. Will we make it by August 2nd?
Well, and there's 4 points I would make. One is, and I'm a little troubled by much of the reporting I see on this. So let me comment on that. One is that legislation takes time, and actually, I don't think that we're going to make the August 2nd deadline because there isn't enough time actually left to technically get through the legislation.
Right.
So part of the reporting where they're asking the question, are we going to make the deadline or not, I think is a little bit misleading. I believe that likelihood is very high that we'll go past that deadline. Sure. Okay. And so what does that mean? Yeah. Because the second thing that you hear is, well, that means default. And actually, I think this is a little irresponsible as well. It doesn't necessarily mean default. Right now, for every dollar that the government is spending, it is borrowing 40 cents. That's a lot. That's a problem. Yeah. But they're bringing in 60 cents worth of revenue. So they got 60 cents to work with. Compared to that 60 cents, interest on the debt is about 9 cents.
Okay.
Social Security payments are about 16 cents. So they've got enough money to pay the interest on the debt, pay Social Security, and some other bills. They're going to have to decide what things that they're not going to pay, but I just can't believe that they're going to choose not to pay the interest on the debt or send out Social Security checks. They may slow down payments to things like defense contractors or hospitals or things like that for a little while.
Right.
I don't think it'll be, they'll make it seem like a big deal, but it's not as big a problem as is being represented in the common reporting, and it doesn't necessarily mean a default.
Right.
Okay. So it troubles me the constant use of the word default in the discussion about that.
Well, and the part that goes right along with that, of course, is they're talking about the potential drop in the rating of U.S. government securities. And, of course,
Yep.
Standard & Poor's at the center of that and some other rating agencies. So,
Yep.
Tell us just a little bit about that, if you would.
Absolutely. That was going to be my third point. And I think that it's almost certain that the rating agencies will downgrade the U.S. And the reason I say that is that they've been very clear. Moody's and S&P have been very clear that they're looking for about $4 trillion worth of cuts in order to keep the rating that we're at. And the numbers that we're talking about now are not in that neighborhood. They're more like $1 trillion or $2 trillion or $2.5 trillion. They're not the $4 trillion. And the rating agencies are more concerned about the deficit than
Sure.
they are about the debt ceiling. The debt ceiling is actually a little bit of a distraction in the whole larger issue of the projected deficits and the amount of debt that the government is projected to borrow. That's what they're really concerned about. What they really want to see are credible reductions to that debt, and they're not seeing it yet.
Absolutely. So obviously, as you said, the debt ceiling is what makes press because it's got a deadline to
Yep.
it. And when we talk about managing the national debt, long-term thing, they don't know how, the press doesn't know how to get their arms around that one, so we really, really don't hear much about that.
Well, and we've known about it for a couple of years.
Sure.
This is not a new issue. It's been known, but sadly, perhaps, unless there's some sort of deadline that forces Washington to address this,
Yep.
which is what the debt ceiling has done, it requires difficult choices, and they put off the difficult choices as long as they can, which actually brings me to my fourth point, which is, even if we come to an agreement on some deficit reduction and we get past this debt ceiling, we're not done with this issue.
Right.
Realistically, the amount of deficit reduction that is necessary just to stabilize the debt as a percentage of GDP, as a percentage of the economy,
Right.
is more like $6 or $7 trillion.
Wow.
So, this is a step along the way, but this does not solve the problem completely. We're going to be arguing about this through the 2012 campaign and probably even after that.
Sure, because it's such a big amount. Now, so again, you said that the autopilot part of our overall budget comprises about what percent?
Yeah, let's talk about spending,
Yeah.
and let's talk about growth of spending. And when you listen to debate in Washington, it's important to understand the difference between what they call discretionary spending and what they call mandatory spending.
Sure.
Mandatory spending makes up about 2/3 of the money that we're spending today.
Yep.
It is almost entirely made up of interest on the debt and entitlement programs. Social Security, Medicare, and Medicaid make up the vast majority of mandatory spending. Mandatory spending is on autopilot. It
Yeah.
just keeps going unless legislation is passed. It is also what is driving the growth in spending. So it's not just what we're spending today, it's how the growth of spending is projected over the next several decades, for that matter. And it's entitlements as the baby boomers retire that is driving the rapid growth in projected
Absolutely.
spending, Social Security and Medicare in particular.
And probably then why it's even on the table for discussion in Washington, because I know, it's been the sacred cow. You can't
Yeah.
touch Social Security payments, but it's actually been on the table this go around because it's such a huge chunk of the overall deficit.
Well, we're beginning to talk about that, but if you dig into the spending cuts that are being proposed in either the House plan or the Senate plan, they're really about the small part, discretionary spending, not much about mandatory spending, which is what's driving growth. And discretionary spending, roughly makes up about 1/3 of the spending today. If you take that third and you divide it in half, about half is defense, and about half is other programs, funding the departments of the government, the energy department,
Sure.
the EPA, things like that. That's the discretionary part, and that's where most of the talk is focused now. They haven't really tackled the difficult part, which is mandatory spending.
Okay. Okay.
So we really have the toughest problems still in front of us.
Okay.
Even if we get past the more immediate issue and the cuts that we're talking about now and the debt ceiling.
Okay. So let's go back for a minute, Russ, to the rating of U.S. government security, because you walked us through a little bit about the probability of this rating changing. But what kind of effect? I mean, we're hearing different things on the news. Let's say that the rating, as you say, will probably drop to AA instead of AAA or AA plus, depending upon the rating agency. What, okay, so, the couple that's sitting at home today says, how will that affect me? What will that do?
Well, that's a good question, Scott. The thing is that the markets have been watching this for a long time,
Right.
And the rating agencies for several months have been pretty clear in terms of their write-ups. It doesn't get reported very much in the mainstream media, but in terms of the things that I read every day, they've been pretty clear about what they're expecting.
Yep.
And I would argue that right now, the expectation for a downgrade is already in the interest rates that the government is paying. Now, there are a lot of things that affect interest rates. Rating's only one of them.
Yep.
And there's lots of counterbalancing issues, but I think this has already been affecting rates. Now, if you look at, let's make one comparison just so that people don't become overly alarmed by this.
Yeah.
Japan is AA rated. So we're talking about the same rating as Japan, but interest rates in Japan are actually the lowest in the world.
Right.
So, I mean, that's a good example of there are a lot of things that affect interest rates other than just the rating. I think it's largely already in the pricing of the market. When it happens, might there be a little jiggle? Yes, but, rates aren't going to shoot. I don't expect rates to shoot to way up through the roof or anything like that.
Okay, so the other part of this that the news media is talking a little bit about is, what about China? China is the biggest investor in U.S. Treasuries, and are they going to somehow be discouraged by this lower rating? Is there any risk going on there? And of course, China, a statement came out of China, I'm not exactly sure who said it, that, they're very upset with this fight between the donkeys and the elephants.
Yeah. Well, that's a good question because China does own a lot of U.S. debt. They own a lot of U.S. debt for a couple of reasons. One is that their trade imbalance with us is quite high. So, when we buy things that are manufactured in China, we give them dollars, they give us, their currency.
Right.
We buy their gizmos.
Yeah.
And they take the money and they buy U.S. securities with
Right.
it, right? So
Complete the circle.
it completes the circle. So you need to understand that. So they are going to still want to sell us the things that are manufactured there,
Right.
which means they're still going to have dollars
Yep.
to invest. Now, they also like to give us a poke in the eye whenever they can because, of course, we harangue them about civil rights.
Yes.
They view us as interfering in their domestic affairs with Taiwan, for example. These are things that we do that aggravate them. So every chance they get to kind of aggravate us with things like criticizing us on this, they're going to do that. So
Right.
you need to understand a little bit about the history and the politics there. The other thing to know is if they don't buy our securities, where are they going to go? Are they going to go to Europe? There's really not a better place.
Right.
I mean, for all the problems that we've got, the United States is still the biggest and the best and the strongest in the world. Hopefully we'll keep it that way, but that hasn't changed, and there's really not a better place for that money to go.
So it's very unlikely that the Chinese would be in any way dissuaded by our drop.
I don't think it's going to be a material reaction.
Right. Okay, good. Well, we have Russ Swanson, the Chief Investment Officer for Thrivent Financial, with us here today, and we're going to be back after the break and talk a little bit about what does the rest of the year look like. Let's take a look at some forecasts for the economy and maybe even talk a little bit about the stock market and some investment opportunities and how they might be affected. So thanks, Russ.
You're listening to Financial Strategies with Scott Wardell.
Nearly 3 million members look to Thrivent Financial for Lutherans to help them achieve their financial goal. Nearly 3 million people know that Thrivent Financial is committed to excellence in financial services and caring for others. Get to know Thrivent Financial and the quality of products and services they can offer you. In West Central Minnesota, your representatives to help you with your financial needs are Wayne Grunkley and Alan Sogstead, 215 Atlantic Avenue, Morris. Call 589-1731. Registered representatives for securities offered through Thrivent Investment Management Incorporated, member FINRA and SIPC.
And, of course, that music means we're back here with Financial Strategies with Scott Wardell. And before we continue on, we've talked a lot about debt ceiling and everything else here. But we do have our deal of the day, Scott, don't we?
Absolutely. And the deal of the day today is called Financial Insights. It's got a couple of really great articles, which I think will really help our listeners here today think about their own specific situation. So it's got an article called Are Your Investments Tailored to You? It has a market view, stocks and bonds head down diverging paths. And then, Russ, there's an article that you wrote in here as well called Taking Stock. It's a really good 17-page brochure, and I encourage people who are listening today, pick up the telephone and call this number, 1-855-346-4332. That's 1-855-346-4332. That actually spells out something. The 855 is a toll-free extension, and then it's FIN, which FIN stands for Financial
What?
Idea, IDEA.
Wow.
IDEA. So,
boy, whoever thought of that must have gotten a pay raise.
Yeah, I wish. But pick up the phone, folks, and give us a call. And I want to welcome our new listeners, not new to this week, but new this month in Montevideo, Hutchinson, Wilmer, Morris, and Thief River Falls. And also a warm welcome to our listeners that in New Prague as well. So thank you, everybody, for tuning in. We've got Russ Swanson here. And Russ, you know, we've been talking about the debt ceiling. We've been talking about what does this all mean, possible drop in the rating. Now let's shift gears a little bit and look at the rest of the year in terms of our economic growth, economic recovery. What is it that you see from where we're at this point in time?
That's a good question, Scott, because it's important to, stay focused on what you think is going to happen in the future. And one of the most significant things that we follow is the index of leading indicators. And this is an index put out by the Conference Board. It's made up of 10 components. And the leading economic index has actually been showing growth as we look forward. And we use it. We're expecting that by the time we get to the end of the year, that the economic growth for the year will be about 2%.
Okay.
And as we look toward next year, about 3%. As I said earlier, coming out of a recovery, you'd expect it to be stronger than that. But still, it's positive growth. That helps earnings. As I said earlier, also, it's not going to improve the employment picture very quickly, though.
Okay.
And that's going to have political implications, because when employment is bad, that's the single biggest thing that affects elections. And
yeah.
Of course,
people vote with their pocketbooks.
2012 is an election year.
Right.
So.
Okay. Isn't the old phrase, "It's the economy, stupid"? Isn't that the?
Yeah.
Yes, and it was true then, and it's true today. So that's what we expect as we look forward.
Okay, so now if we transition, then we say, okay, that's the big economy. And you look at our current situation in the financial markets, where do you see things may have be currently undervalued a little bit, and where might they actually be overvalued? What are the opportunities?
Sure. Well, of course, there's a lot of things on the menu. So let me just talk about two of them. One that's on the end of the spectrum where we like it, and one that's on the end of the spectrum where we like it much less.
Right.
Okay.
Right.
On the end of the spectrum that we like are large, multinational U.S. companies.
Mm-hmm.
And let me give you a few statistics to illustrate why we like this. I talked earlier about how strong earnings have been, that the economy has grown back to the levels that it was at before the downturn. Well, if you look at, I mentioned the S&P 500, so I'll start with that. The S&P 500, even though earnings are at all-time levels, are still about 17% below where they were before the downturn.
Okay.
So the values have, even though earnings have improved, the values haven't improved. And if you look at the biggest 100 companies from the S&P 500, they're still 20% below where they were before the downturn. Now when we talk about values, we like to use kind of a shorthand term called the PE ratio, the price compared to earnings.
Sure.
The price earnings ratio. The PE ratio for the S&P 500 in round numbers is about 14 right now. For the S&P 100 is about 13.
And where does it normally run then, Russ?
Around that level, or maybe a little bit higher.
Sure.
So this is sort of, I would say, maybe just a little bit cheap, you could argue.
Right.
Now let's compare that to the numbers, similar numbers for small stocks.
Okay.
Right? There is an index called the S&P 600. These are small companies. And right now, small companies have risen back to about the levels that they were before the downturn.
Okay.
So instead of being at a discount to where they were before the downturn, they've come pretty much back to where they were. And the PE ratio there is 23 times earnings.
Okay.
Right? So sort of 23 for small companies and only 13 for the 100 largest companies. The other thing that we like about the large companies is, as I said, these are big companies that sell overseas. They've got a diversified customer base. They're benefiting from growth over in Asia and places like that. So they've got a lot of earnings power. I think that if there was a downturn, you've got some protection there because you've got a little more diversification. So we like big, large domestic companies.
Just you say we favor them.
We favor them.
Favor them, whereas we're still, certainly holding a variety of other kinds of investments. You're not talking any kind of wholesale shift here. You're just talking some adjustments.
We that's right. We lean. You always have to stay diversified.
Yep.
And that is true also for asset classes. So, but we like to lean into things that we think are cheap, and lean out of things that we view as expensive. So let's talk about the expensive end of the spectrum.
Okay.
And there I'm going to talk about Treasury securities. We talked about that a little bit earlier. If you look at the yields, Treasury securities the yields are very, very low. And particularly on the short end. For all practical purposes, short-term yields are zero. If you look at money funds or bank deposits.
Well, people know this well who are listening because they
Right.
have money markets, and a whole bunch of them have certificates of deposit at the bank that are, renewing at these incredibly low rates. So they know, some of this.
Right. So, they're very, very small or zero rates on the short end of the yield curve. Now, normally short-term yields are at least equivalent to inflation.
Right.
And inflation has been running lately around 2%. So you'd expect short rates to be at least 2, maybe a little higher.
Yep.
So that tells me that they're at least 2% below kind of normal or equilibrium. And that's because the Federal Reserve has had very, very expansive monetary policy. They've driven short rates down to zero.
Yep.
And when that wasn't enough, they started buying up other securities. They just finished a program at the end of June called QE2.
Yep.
That's a shorthand for a rather awkward phrase, quantitative easing.
Right.
It's not a very helpful description, but what it really means is they're printing money, figuratively speaking, and they're buying securities in the market, and and they've stopped doing that now, at least for the time being. But they've been buying a lot of securities. So the low rates that are easy to illustrate when we're talking about short-term rates really also work their way out through fixed income or bonds that have longer maturities. The effect is less the longer the maturity is, and it's greater the shorter the maturity is, but the effect is still there. You know, another way to look at this is to look at securities that are often called TIPS, Treasury Inflation Protected Securities.
Right.
These are securities that the Treasury issues that are meant to provide some protection against inflation.
Yep.
So they typically pay inflation plus something, right?
Sure.
And the typical, depending upon the maturity, is inflation plus between 2 and 4%.
Yep.
If you look at what the yields are on TIPS, everything that is at 5 to 7 years or shorter is actually trading at a negative yield to inflation. So you get inflation minus something,
right,
instead of inflation plus something.
That does not sound good.
And the shorter it is,
right,
the bigger the minus is.
Yeah.
Right? So very short-term TIPS bonds are trading at inflation minus 1 or 2%, which again is sort of consistent with the discussion that we just had about short-term rates.
So that's in that category of don't like those quite as much right now.
That probably defines the opposite end of the spectrum in terms of things that we favor the least.
Okay, so as you're talking about this, I think that we can say that we've kind of followed a classic recovery because we got a good run on the small cap, mid cap, through the market coming back after March of 2009, so 2010 into this year. And you're saying now typically, isn't this fairly typical that the larger companies would start to show these earnings growth at this stage of recovery?
Well, I think it's always a question of what's typical, but I think you're right that often small and mid-cap stocks are more sensitive, so they often get hit harder and quicker in a downturn and bounce back faster. Yep. And the big companies tend to be a little less sensitive and maybe have more staying power longer into the recovery.
Right. So maybe some adjustment in people's portfolios from not leaving those small cap and mid caps behind because they have done well, but maybe some adjustment over to the large cap would be prudent at this time, dependent upon their risk tolerance and other things.
Right. Everybody's situation is different, but if you're just looking purely at where values seen, the value is relative. Yeah. How do values look between one thing and another? And I'd say you're exactly right.
All right, we're starting to take a break here, and then we'll come back. We got a whole lot more we still got to touch on.
Absolutely, we do. And one of the things I want to make sure people understand here in the next section here, we're going to really kind of try and boil it down to what does this mean for me? Gosh, this is interesting information. How do we take it and say, how do I improve my own particular investment situation? What are some of the questions I should be asking my financial advisor? What are some of the things I should seek out more information on? Because the whole goal of this show is to get people to pay attention to some important things in their financial life that might be just floating along without it. So.
All right, we'll have more financial strategies with Scott Wardell. That's coming up in just a bit.
How would your financial life improve if you changed just one thing? Avoid ATM fees, make your gifts rather than buy them, protect yourself from identity theft, save more for your family's future. The list goes on. If you heard something today on financial strategies that motivates you to change one thing in your life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing. Think about your finances, your lifestyle, your wants versus your needs. What one thing can you change today and see the impact tomorrow? Perhaps your family will save all your change for a month and donate it to charity. Maybe you'll finally write a will. Whether you choose to start simple or take a big step, that one thing can really make a difference. If you heard something today on financial strategies that motivates you to change one thing in your financial life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/onething.
And we're back here on Financial Strategies with Scott Wardell on this Saturday, and whole nother day and a whole lot of fun. And boy, we're talking a lot of good stuff for you today here on the show. And boy, we touch on a lot of things.
Yep, we talked about the debt ceiling. We've talked about the economy. We've talked about the markets. Russ, I really appreciate you being here with us. We have Russ Swanson, the Chief Investment Officer from Thrivent Financial. And I do want to also emphasize our, as you call it, the deal of the day one more time if we can. It is a brochure called Financial Insights. It's got several great articles in it. It's articles like Are Your Investments Tailored to You? Stocks and Bonds Head Down Diverging Paths. And Russ, you've got an article in here called Taking Stock. And people can get this by calling this number, 1-855-346-4332. That's 1-855-346-4332. So pick up the phone. If you've been listening to this and we've somehow sparked some interest and you're saying, gosh, I'd like to know a little bit more about this, pick up the phone today. Call that number. It's a recorded message. Leave your name and your address, of course, so that they can send it out to you. And they'll get it out to you, I would say probably about the middle of the week. So it's a really good little brochure.
So you can get that deal of the day anytime. Get that deal of the day with just give you guys a call once again for that. And, of course, those numbers as you've given before. Fin idea. Boy, that makes a lot of sense.
Yeah.
Financial idea. It's almost like you guys are thinking with that. All right. Let's get back to our topic. Of course, we're talking with our guest this week is Russ Swanson. We're talking a lot about what people are hearing a lot in the news these days, in the debt ceiling. Well, Scott, now if I know my investment companies have come out with maybe some funds that have a wide range of investments inside of them, how do these funds work? Let the listeners know, how do these funds work then?
Sure. And so, if you've been listening to Russ talk about the fact that, there are certain investments that are favored right now over others going forward, and having that forward look, we're talking just a little bit about, there's a category of mutual funds that or other ways people can invest to get in each of those key areas. So they should have some mid-cap. They should have some small cap. They should have some bonds in the portfolio. They should have some large cap. They should have some large cap value. They should have some large cap growth. So how do they do all of this? Well, you can go online and read about asset allocation funds and some of these funds that provide all-in-one balance. And this is a way, so if people are listening and go, gosh, this is great, but how would I ever put this in play? The easiest way is to let it be put in play for you, very frankly, and let the investment managers then start to make those adjustments over time. And there are very few investment managers that will make wholesale changes. Most will just make some adjustments in the portfolio to take advantage of some of the things that Russ is talking about here today. So we in our business call them tilts. Russ earlier said leanings, if you will. But how do you just make some smaller adjustments in the portfolio so you get a little heavier into particular areas? When people have 401ks, I haven't seen a lot of asset allocation funds in 401ks, but I do see a lot of target funds. And what a target fund typically is it picks a particular date. So I bet you we have listeners today that own a 2020 target fund, which is just a fund that is targeted towards 2020 as a potential retirement date. And what they do is they adjust over time to a more conservative position. And that is one way in which to get a lot of balance and some adjustments over the time. There's a small difference, but I think a significant difference with an asset allocation fund, because they are not as targeted on a date as they are on an asset allocation model that fits a particular risk tolerance. And by fitting that risk tolerance, making some adjustments according to what the market is telling them, as they're going. So where are the particular opportunities? So people can do this fairly simply. That's my point, is you've got to, one, stay on top of it. Two, you've got some questions you need to ask your advisor. So if you are one of those people who has got 13, 14 mutual funds in your portfolio, and they are designed to get you a whole bunch of diversity, but also some balance, I think I'd pick up the phone and call your advisor this next week and say, you know, how are we relative to small cap versus large cap? How are we balanced relative to bonds versus stocks? Is there anything we should be doing differently given the situation that we're in right now? And again, Russ said it earlier, we're not trying to alarm anyone because this is not what it's about. It's about managing. And to manage your money, you got to pay attention, and that's what today is all about. So at any rate, Russ, let's get back to you here. We were talking about the parts of the financial markets that might be overpriced, underpriced. Give us a sense, is there anything people should really fear right now? Is there any part you'd say, whoa, that, you know, there's a possible outcome that could, you know, be adverse to them?
Well, I don't like to use the word fear, but I think, you know, we need to be realistic, okay? Yep. And what I've tried to do today is, because the news has been so bad lately, to, you know, fill in a little bit of the gaps with some of the good news that's out there as well, leading indicators, corporate earnings. But the fact remains that we're in very uncertain times right now. So this is sort of the negative side. Particularly with fiscal policy in Washington. We've seen that on the news constantly. That's a real challenge. Now, when I think about that, the thing that I worry about most is not the stuff that we're seeing right now.
Okay.
But it's longer term, like
Sure.
Will we solve the bigger, longer term issue that I talked about earlier? So for example, a scenario that would trouble me would be we go through the 2012 election, we end up still with gridlock, and because of gridlock, we can't really find a compromise to solve the long-term problem. And if we don't do that, because of the automatic spending nature of mandatory spending, the problem just keeps getting bigger and bigger and bigger, right? So that would be a thing that I would worry about. So as I look forward, I'm paying particular attention to how that's going to play out. And that, you know, that plays out over the next 18 months, right?
Right.
The second thing is another big uncertainty is monetary policy. We didn't talk a lot about the Federal Reserve today, but I know that there are a lot of people who are worried about whether the Fed has been too easy, whether they will ignite inflation. Very good question. You know, we are in a place that we've not been before. You know, we're engaged in monetary policy that we don't have any experience with, right? So we're trying to estimate what will happen. I will say this, that there are a lot of very smart people at the Federal Reserve, and they all want to do the right thing, right? So there isn't the same sort of political, you know, risk at the Fed that you have in Washington. They're all well-meaning, smart people working hard to do the right thing. So I'm a little bit less concerned, but we're way extended there. And, you know, I hope they get it right. I can't think of better people to do that,
Sure.
but there's a lot of uncertainty around that as well, and the inflation question.
Okay. Well, and you know, if I were to kind of summarize some of the macro stuff that we've talked about today and get it down to, you know, what does it feel like at the kitchen table? One of the things is that, you know, we've seen this last week where the market dropped like 600 points. That gets people a little bit upset, especially those people, you know, that, you know, in 2008 and the beginning of 2009 really saw that their investments fell dramatically.
People are really sensitive.
They're really sensitive. So they've seen that. Now this week they saw a 600-point drop. And what happens so often is they get categorical in their thinking, Russ. And so what they do is then they rush and say, well, I think I don't want anything you know, in my portfolio, in my investments, that I could lose any money on, so that they tended to go to CDs. Well, as you know, CD rates are historically low. I mean, we're looking at 1% oftentimes, I'm generalizing here, for, you know, a lot of these CD renewals. So I have a real soft spot for retirees that are living off their interest income, and they've come down from 8% to 6% to 4% for a period of time now, all the way down to 1%. That's a huge drop. And so one of the things that I would encourage our listeners here to do today is there are so many good ways today that you can mitigate some of the risk of especially the growth part of your portfolio. And I'm not going to go into the details of it today, but especially I was meeting with a couple yesterday, as a matter of fact, and they were getting their retirement all planned out for them. They were 55 and 56, and I said, wow, this is so fun to be working with you guys because so few people are really looking at early retirement anymore. And one of them, the husband was going to retire in a year, and his wife was going to retire in 3 years, and we were getting that planned out for him. I said, but here's the dilemma, and this is what we really have to solve. You could easily have 30 years, maybe even 40 years of retirement. And they stopped and kind of gave me a blank look, and I said, now, how long have you worked? And they said, well, about 32 years. I said, you've worked 32, and I'm talking about retiring for 35.
Yeah.
You've got to have some growth. I don't see how it can work without some growth
Right,
in 35
absolutely.
years.
People underestimate the length of time that they're going to be retired. You know, the average 65-year-old will live another 20 years, which means half of them are going to live longer than that. So
Right.
it's a long retirement these days.
Right. So again, so here's the dilemma underneath the dilemma. And that dilemma is if you need growth and you don't like to take the risk associated with growth, what do you do? And that's where I'm encouraging people to pick up the telephone and, first of all, call and get this brochure, but also call and work with a financial advisor, work with a financial professional to get the kind of consultation you need to say, how can I mitigate this risk? Because it is a little bit frightening out there, but it's not that there aren't really, really great ways to do that.
Right, and you need to be able to sleep at night. When people ask me, you know, what should I do, you know, it's hard to advise them because what makes sense for them,
Right.
what makes sense for me might not make sense for them. So the first thing I tell them is, look, you have to be able to sleep at night.
Right. And, you know, we give everybody this quiz that comes in. They have to answer 9 questions so that we're not just guessing at their risk tolerance, that we've got some diagnostic, way in which to do that. So, Russ, I want to just say thanks again for being on the show today. Any last words for our listeners here?
Thank you so much for having me. It was a pleasure to be here. And I guess one last word would be, you know, make sure you're looking forward, not just at, you know, what's on the television today.
Right, absolutely. Thanks so much for joining us. Just absolutely, we're honored and delighted that you could be here today. And thanks to all our listeners for tuning in, and call that number to get today's free brochure.
You've been listening to Financial Strategies with Scott Wardell.
We hope you've enjoyed the past hour of Financial Strategies with Scott Wardell. While various products may be discussed during the course of this program, please note that these discussions are intended only to educate you about financial topics. They are broad in scope and do not consider your individual personal financial situation. You should work with a qualified financial professional in collaboration with your attorney and tax advisor before implementing any financial decisions which will affect your personal financial situation. Thrivent financial representatives cannot provide legal or tax advice. Your local Thrivent representatives are Wayne Grunkley and Alan Sogstead, 215 Atlantic Avenue, Morris. Call 589-1731. Join us again next week for Financial Strategies with Scott Wardell on KMRS Morris.